Welcome back, everyone, to another deep dive. This time we're tackling something that can seem a little intimidating at first, financial statement analysis.
Yeah, it can seem pretty dry.
But we're going to try and liven things up a bit. The goal here isn't to make you accounting whizzes. It's about giving you the tools to understand those reports and what they really tell us about a company.
It's like being able to read a company's secret language.
Exactly. So we can figure out if they're a good investment or maybe spot some trouble brewing under the surface.
You're thinking of this like a detective.
Kind of. So we start with the basics. What exactly is financial statement analysis, and why should anyone who's not an accountant care?
Well, at its core, it's about taking a company's financial reports, their balance sheet,
Right.
income statement, statement of cash flows, and using them to assess the company's financial health.
So it's not just about seeing how much money they made last year.
Right. It's way more than that. It's about figuring out if they're profitable, if they have enough cash to operate, and if they're managing their debts well. All of those things can give us clues about their future performance.
And that's where it gets interesting for investors.
Exactly. You can use this information to decide if a company is worth investing in or to compare different companies in the same industry.
Now, I know there's a framework out there that makes this process a little less daunting.
Absolutely. There are 6 key steps. We'll go into more detail later, but the first one is crucial: defining your objective. What do you want to learn from this analysis? Are you looking for investment opportunities, trying to evaluate a potential supplier, or just trying to get a better handle on a company's overall financial health?
So it all starts with a clear goal in mind. What comes next?
Then it's about gathering all the data you need to answer that question, and that goes beyond just the financial statements.
You mean like looking at industry reports and economic data?
Exactly. You also want to look at things like news articles, company presentations, even regulatory filings. And don't forget, talking to management or industry experts can give you valuable insights too.
So it's about putting those financial statements into context.
Absolutely. Then comes the fun part: processing that data. We're talking about adjusting the statements if needed, calculating ratios, and visualizing trends. This step is where you really start to see the story emerge from those numbers.
So you're turning raw data into something we can actually understand and analyze.
Precisely. Then comes the real detective work: analyzing and interpreting those findings. Do the numbers support your initial hypothesis? Or are there any red flags popping up? This is where critical thinking comes in.
So we've gathered the data, crunched the numbers, and drawn some conclusions. What's next? Do we just file that report away in a drawer?
Nope. The next step is communicating those findings. That could be a written report, a presentation to investors, or even just a conversation with a colleague. The key is to present your insights clearly and concisely.
Makes sense. And of course, the business world is constantly changing, so we can't just do this analysis once and call it a day, right?
Definitely not. The final step is updating your analysis regularly. Markets shift, companies adapt, new information emerges. You need to revisit your assumptions, see if your conclusions still hold true, and adjust your analysis accordingly.
So it's an ongoing process, not a one-time event.
Exactly. That's why it's so important to stay informed about changes in accounting standards, new types of transactions, and industry trends. Resources like the IASB and FASB websites are great for that.
Okay, so we've got this roadmap for analyzing financial statements. But let's be honest, the financial world can seem a little overwhelming with all its rules and regulations.
It definitely can be. There's a whole ecosystem of standard-setting bodies and regulatory authorities. In the U.S., we have the FASB setting the Generally Accepted Accounting Principles, or GAAP, while internationally, the IASB sets the International Financial Reporting Standards, or IFRS.
And those are the rules companies have to follow when putting together their financial statements.
Exactly, but it doesn't stop there. We also have regulatory authorities like the SEC in the U.S. making sure companies are following those rules and presenting their financials fairly. Internationally, there's IOSCO, the International Organization of Securities Commissions, working towards consistent regulation across different countries.
So it's a whole web of organizations trying to make sure everyone's playing by the same rules. But why should the average person care about all this?
Well, these standards and regulations are designed to protect investors and ensure transparency in the markets. When you're looking at a company's financial statements, you want to be confident that those numbers are reliable and comparable to other companies.
So it's about having a level playing field.
Exactly. You want to be sure you're comparing apples to apples, whether you're looking at a company here in the U.S. or overseas.
Makes sense. Now, let's be honest. Sometimes those financial statements can be pretty dense. Are there any other sources of information we should be looking at to really understand a company?
The main financial statements are just the tip of the iceberg. Think of them as the highlight reel. But for the behind-the-scenes story, you need to dig into those footnotes.
Footnotes. They always seem so tiny and technical.
No, right? But they're packed with valuable details about accounting methods, key assumptions, and even estimates that can significantly impact the numbers you see on the main statements. They're like clues in a detective novel.
So we could find something in the footnotes that completely changes our understanding of a company's financial position.
Absolutely. And don't underestimate the value of management's discussion and analysis.
That's the section where they explain the numbers, right?
Right. It gives you a glimpse into their strategy, the risks they see on the horizon, and their overall outlook for the future.
But, sometimes it feels like they're trying to spin things in the most favorable light.
True, you have to maintain a healthy skepticism. But even so, management commentary can provide valuable context and help you understand the company's decision-making.
Okay, so we've got the main statements, the footnotes, and management's take on things. What about those audit reports? They sound pretty official.
Audit reports are like getting a second opinion from an independent expert. Certified public accountants review those statements and make sure everything's on the up and up.
So they're looking for any funny business or errors.
Exactly. They check if the company followed the accounting rules and assess how well they're managing their internal controls.
Internal controls, what are those?
They're the processes and procedures a company uses to make sure their financial reporting is accurate and reliable. Things like separating duties, having multiple people check transactions, and regularly reviewing their systems.
So it's all about preventing errors and making sure the numbers are trustworthy.
Right. The auditor then issues an opinion based on their review. The best case scenario is an unqualified opinion, which means they believe the statements are fairly presented. But qualified or adverse opinions, well, those are red flags you definitely want to investigate further.
So it's like a seal of approval from the accounting police.
Pretty much. Now, we've talked a lot about looking at the company as a whole, but sometimes you need to zoom in and see how the different parts are performing. That's where segment reporting comes in.
Segment reporting, you mean breaking down the financials by different product lines or geographic regions?
Exactly. It's about understanding the performance of each individual business unit. You can see which segments are driving revenue and profits and which might be lagging behind.
So it's like peeking under the hood to see how each engine is running.
That's a great analogy. Segment reporting can give you a much more granular view of the company and help you identify the areas that are really driving its success or holding it back.
That's incredibly valuable information. But I have to ask, does all this get way more complicated when we're talking about international companies? I mean, aren't the accounting rules different all over the world?
You bring up a good point. While there are efforts to harmonize accounting standards globally, there are still differences between, say, IFRS and US GAAP.
So comparing companies from different countries can be tricky.
Exactly. You have to be aware of those nuances and make sure you're comparing apples to apples.
That makes sense. Now, I know our listeners are eager to dive into all this, but the world of financial reporting is constantly evolving. How can they stay ahead of the curve?
The key is continuous learning. New standards are being developed all the time, and new types of transactions are emerging that might not fit neatly into existing rules.
So we need to stay flexible and keep up with those changes.
Exactly. Make it a habit to check out resources like the IASB and FASB websites. They've got tons of information on the latest developments in financial reporting.
Great advice. And don't forget those footnotes. They might hold some hidden gems. But let's be honest, the required reports and filings are just one piece of the puzzle.
Right. You can find a wealth of information from other sources, too. Think about earnings calls, where companies discuss their results and outlook directly with analysts and investors. Or press releases, where they announce major news and developments.
It's like getting information straight from the source.
Exactly. And don't underestimate the value of public third-party sources. Industry reports, trade journals, even government data can provide valuable context and help you understand the competitive landscape.
So we're talking about painting a complete picture of the company and its industry.
Exactly. Then, for those who really want to go deep, there are proprietary sources like analyst reports. These can offer in-depth analysis and forecasts, though they often come with a subscription fee.
So it's like getting expert opinions on a company's prospects.
Exactly. And finally, nothing beats hands-on research. Trying the product, visiting a store, or even talking to employees can give you a feel for a company's operations and culture that you just can't get from reading reports.
It's about getting a real-world sense of how the company operates.
Absolutely. The more pieces of the puzzle you can gather, the better your understanding of the company will be.
Well, we've covered a lot of ground here today. From deciphering financial statements to uncovering hidden gems and footnotes and exploring a whole world of additional information sources, it's clear that financial statement analysis is a powerful tool.
It really is. But before we dive into the nitty-gritty of analyzing specific statements, I want to emphasize one key point.
I'm listening.
This isn't just about investors making money. Financial statement analysis can empower anyone to make informed financial decisions. Whether you're an entrepreneur starting a business, a manager making strategic decisions, or just someone who wants to understand how businesses work.
So it's about more than just picking stocks.
Exactly. These statements tell a story. Understanding that story can make all the difference in your financial life.
So before we move on to the next stage of our deep dive, any final thoughts for our listeners?
Just this. Don't be intimidated by those numbers. Remember, they're telling a story. It's up to us to ask the right questions, connect the dots, and uncover the insights hidden within those financial statements. Keep learning, keep exploring, and you'll be amazed at what you can discover.
Fantastic advice. Now let's take a quick break, and when we come back, we'll delve into some real-world examples of how you can use financial statement analysis to make smarter decisions. Stay with us.
All right, let's shift gears a bit and talk about using all this information to spot those red flags. Let's say we're looking at a company's balance sheet, and we notice their debt-to-equity ratio has been creeping up over the past few years.
Okay, that does sound a little alarming. But wouldn't that be obvious just from looking at the main statements? Why do we need to dig into the footnotes or other sources for that?
Because sometimes those footnotes can reveal a hidden story. Like, imagine if a big chunk of that debt is coming due in the next year or two.
Oh, wow. So suddenly that rising debt-to-equity ratio becomes much more concerning.
Right. It's like finding a hidden clause in a contract.
What about management commentary? How can that help us spot potential issues?
Well, let's say they're talking about increased competition or rising costs, but they don't mention any plans to address those challenges.
So we're looking for inconsistencies between what the numbers say and what management is telling us.
Exactly. Those inconsistencies can be red flags. What about audit reports? What should we be looking out for there?
Well, we want to see that unqualified opinion, right?
Right. An unqualified opinion is what you want to see. Anything else, a qualified opinion, an adverse opinion that's assigned to dig deeper and figure out what's going on.
It's all about reading between the lines and looking for those subtle hints that maybe something's not quite right. But this isn't just about avoiding bad investments, right?
Yeah.
Can we also use this to find hidden gems?
Absolutely. Financial statement analysis can also help you identify undervalued companies. Maybe you see a company whose stock price is down, but their financials are solid.
Intriguing. Give me an example.
Sure, say you're looking at a retail company. Everyone thinks they're going out of business because their physical stores are struggling.
Ah, the classic retail apocalypse story.
Right. But then you look at their segment data and see their online sales are booming. Maybe they're adapting well to changing consumer behavior and have a lot of potential for growth.
So even within a single company, we can find clues about their future by looking at the different pieces.
Precisely. It's about seeing the bigger picture.
What about from a lender's perspective?
Oh, it's crucial for lenders. Let's say you're considering a loan to a manufacturing company. You see their inventory turnover ratio is declining.
Remind me that one tells us again.
That's how quickly they're selling their inventory. A lower ratio might mean they're having trouble moving their products. Dig deeper, maybe you find they're sitting on a mountain of unsold goods, a clear sign they might struggle to repay that loan.
So financial statement analysis is like having a superpower in the business world.
It really is. And it's not just for the experts anymore. Technology has made it much more accessible. There are online platforms, financial data providers, even investment apps that can help you analyze data without needing a degree in accounting.
That's encouraging. What are some key ratios or metrics even beginners should familiarize themselves with?
Well, I'd start with profitability ratios like gross profit margin and net profit margin. These tell you how much profit a company is making on every dollar of sales. Then there are liquidity ratios, like the current ratio and the quick ratio. Those tell you how easily a company can cover its short-term debts.
Of course, we can't forget leverage ratios.
Right. Things like the debt-to-equity ratio we talked about earlier. These tell you how much debt a company is using to finance its assets.
A lot to learn, but it sounds manageable. What other tips do you have for those just starting out with financial statement analysis?
Don't be afraid to ask questions. Reach out to investor relations departments, talk to financial advisors, or join online communities where you can learn from others who are passionate about this stuff.
That's great advice. From your experience, what are some of the biggest mistakes people make when they're starting to analyze these reports?
One of the most common is getting fixated on a single number or ratio without considering the bigger picture.
Like judging a book by its cover.
Exactly. You have to look at trends over time, compare the company to its industry peers, and understand the overall market they're operating in.
So it's not about finding that one magic number. It's about understanding the whole story.
Okay.
What else trips people up?
People often overlook the qualitative factors, the quality of management, the strength of their brand, their company culture. These things can have a huge impact on future performance, but they don't always show up in the numbers.
It's about the human element too, not just the numbers.
Right. And another mistake is not updating your analysis regularly. The business world changes quickly, so you need to stay informed and be willing to revise your assumptions as new information comes out.
So financial statement analysis is a continuous process, not a one-time event.
Exactly. It's a journey, not a destination.
Speaking of journeys, we've come a long way in this deep dive. We've learned to decipher those statements, spot red flags, even find those hidden gems. But there's one more critical aspect we need to talk about: forecasting. How can we use all these historical numbers to try and predict a company's future performance?
That's where things get really interesting. Forecasting is all about taking the insights we've gathered and projecting those trends into the future. We can use historical data, industry forecasts, even management's own guidance to try and create a picture of what the company might look like in the coming months or years.
Now that sounds incredibly powerful, but
Yeah.
isn't it a little like trying to predict the weather? Aren't there just too many variables?
It's definitely not an exact science, but there are techniques and tools that can help us make more informed predictions. For example, we can build financial models that simulate different scenarios based on various assumptions about revenue growth, cost control, or market conditions.
So we're basically running virtual experiments to see how different factors might play out.
Exactly. It helps us test different assumptions and see which scenarios seem most likely based on what we know about the company, its industry, and the overall economy.
Fascinating. But how accurate can these forecasts really be? It seems like there are so many unknowns and unpredictable events that could throw things off.
You're right. We can't predict the future with 100% certainty. Forecasting is more about understanding the range of possible outcomes and assigning probabilities to different scenarios. A well-constructed forecast won't just present a single most likely scenario. It'll explore alternative scenarios and try to assess the potential impact of those unexpected events.
So it's about managing expectations and acknowledging that the future is inherently uncertain.
Exactly. We're not trying to become fortune tellers. We're trying to make the best possible decisions based on the information we have.
Are there any tips or tricks that can help us improve the accuracy of our forecasts?
One crucial aspect is remembering those qualitative factors we talked about earlier: management quality, brand reputation, company culture. Those things can make a big difference in how a company performs, even if they're hard to quantify.
So again, it's not just about the numbers. We need to consider the human element, the story behind the numbers.
Absolutely. Another key is to constantly update our forecasts as new information becomes available. New earnings reports, industry trends, changes in the economic landscape. All of these things can affect our outlook. We need to stay flexible and be willing to adjust our assumptions as we learn more.
It sounds like forecasting is a dynamic process, always evolving.
It is. Think of it as an ongoing investigation, not a one-time event.
This has been an incredible journey so far. We've gone from deciphering financial statements to spotting red flags and even identifying hidden opportunities. But now it's time to take things to the next level and really try to peek into the future. So let's take a moment to gather our thoughts, and when we return, we'll dive deep into the world of forecasting and explore some of the tools and techniques that can help us make sense of what lies ahead. Stay with us. Welcome back to the show. We've covered a lot of ground, from dissecting financial statements to spotting red flags and uncovering hidden opportunities. Now it's time to put on our future-predicting hats and delve into forecasting.
Yeah, forecasting, this is where we take all those insights we've gathered and try to project those trends into the future. It's about painting a picture. What might this company look like down the road?
So we're taking those historical numbers and trying to extract clues about what's to come.
Exactly. One common approach is trend analysis. We look for patterns in the historical data, see if those patterns might continue. Let's say a company's revenue has been growing steadily for the past 5 years.
Okay.
We might use that to project their future revenue, at least in the short term.
So we're looking for those patterns and making an educated guess about whether they'll hold up.
That's the gist of it. Of course, we always have to consider those curveballs, right? Changes in the economy, new competition, regulations. But trend analysis can be a good starting point.
You mentioned financial models earlier. Can you walk us through those and how they can help with forecasting?
Financial models are like really powerful tools. They let us simulate different scenarios, see how those scenarios might play out. We can adjust variables like revenue growth, profit margins, see how those changes affect profitability, cash flow, maybe even the company's valuation.
So it's like running these virtual experiments to see how different factors might impact the real world.
Yeah, that's a great way to put it. It helps us test different assumptions, see which scenarios are most likely based on what we already know about the company, the industry, the economy.
This is super interesting.
Yeah.
But how accurate can these forecasts actually be? There's so many things we just can't predict.
That's true. Forecasting, it's not about predicting the future with 100% certainty. It's more about understanding the range of possibilities, assigning probabilities to different outcomes. A good forecast, it won't just focus on a single most likely scenario. It'll explore alternatives, assess the impact of unexpected events.
So it's about managing expectations and acknowledging that the future is full of surprises.
Right. We're not trying to become fortune tellers here. We're just trying to make the best decisions based on the information we have.
Any tips on improving the accuracy of our forecasts?
Don't forget those qualitative factors. Things like the management team, the brand, company culture. These can make a big difference, even if they're hard to quantify.
So yet again, we need to look beyond just the numbers.
Absolutely. And another thing, make sure you update those forecasts as new information comes out. Earnings reports, industry trends, changes in the economy, all those things can affect our outlook. We got to stay flexible, adjust our assumptions as we learn more.
So it's a dynamic process, always changing and evolving.
Yeah.
What about tools? Are there software programs or platforms that can help make forecasting easier?
Oh, tons. Some financial data providers offer pre-built models, templates you can customize. There are also specialized software programs designed for financial modeling and forecasting. These tools can really streamline the process, make it more accessible.
That's great. Any final thoughts on forecasting?
Just remember, forecasting, it's a powerful tool, but it's only as good as the information you put into it. Be mindful of your own biases, seek out different perspectives, always question your assumptions.
Solid advice. So as we wrap up our deep dive into financial statement analysis, what are the key takeaways you hope our listeners will remember?
I hope they've gained a deeper appreciation for the power of these statements. They really do offer a window into a company's past, present, and potential future. By learning to read between the lines, connecting the dots, we can really start to understand a company's financial story.
It's about so much more than just the numbers. It's about understanding the bigger picture, the trends, and using all those insights to make more informed decisions, whether we're investing, lending, or just trying to make sense of the financial world around us.
And the journey doesn't end here. Keep exploring, keep asking those questions, and you'll be well on your way to mastering this fascinating world of finance.
Couldn't have said it better myself. Thanks for joining us for this deep dive, everyone. We hope you found it informative, and we'll see you next time. Keep exploring and keep learning.